Hello, everyone. Welcome to the Fed Day. Fed Day, Fed Day. Tastes great. Fed Day, Fed Day. What the hell's going on here? If they went and cut interest rates, I mean, look at what the hell the damn stock markets are doing. This is gonna, no, that's not gonna be inflationary now, is it? Oh, goodness. Still don't know what the hell happened here. I suppose I had to get my news feed here. I just loaded up the screen and it's like, Chris, what's going on? I don't know. There's something about a Fed or something. I don't know. Let's see what we got here. So the headline is boom, Fed keeps rates steady. And that's what the market does when the Fed keeps rates steady? What the hell? That's brutal. Oh, goodness. Anyway, if anything, this is what we always say, never trust the first hour of trading following a Fed announcement. Might find the whole damn thing looks exactly the opposite by the time the end of all this. But anyway, there you go. Kaboom. So gold jumped what, $50 an ounce? I don't know what the hell's the number here. I mean, I don't know whether we really want to interpret too much into what we're seeing just right out of the gate here, but stocks themselves, we have the Dow here at about 36.9, call it 37. And after that announcement, we are now at 37.15. Yeah, so it looks like we moved about maybe 200 points or so on the Dow. Not a huge move. NASDAQ, probably the most sensitive part of the market. Should move the most, high beta, all that kind of conversation. 16,594, now sitting 16,664. So what's that? That's yeah, about 60, 70 points. These don't look like huge percentage moves, but nonetheless, I was demoing on the site prior to the Fed some fun little trades that we had. And here's a really good example of why you do not want to have a trade on heading into a Fed announcement. Kaboom! We were short, or at least I was short here on this sim here from the 78.6, my favorite fib. Took some profits, took some more profits when I saw the W come in. And the rule should be, 10 minutes before econs. Guys like Johnny Hoagland, they're running around like a chicken without a head, making sure everybody's got their books all squared up in prop land. So there's 10 minutes before the close. I saw this double bottom come in. And actually, this is like TRI 101. Where there is the predominant trend line off the top. So where is a W? And there's a big fat W. So as soon as I saw that W happen there, I put the order in to square up the position, and I was out. So thank heavens. I build myself as the demonstrator of best practices around TRI. That doesn't necessarily mean I'm going to make a fortune at this, but I will hopefully be a demonstrator of best practices for you people. And a rule of thumb, you have any day trades on heading into some big econ like an FOMC announcement, you better square up the books a good 10 minutes or so ahead of the event, or you're just going to ask to have your head handed to you. Also had a crude short. This one, actually, I wasn't able to get off until I saw this breakout up here, but was able to square up. In fact, this thing will probably come ripping back down. So I'm out of all these little day trades here ahead of that event. And now, ironically enough, we should just sit and just watch the fireworks. And my hunch is you're going to see a lot of back and forth here as we go over the next hour or two. Did notice in previous broadcasts, for whatever it's worth, that Ethereum actually I've found is a really, really good leading indicator for sort of that risk on bet I even found that it even led things like the Russell 2000 and stuff. So where's our Russell 2000 down here? Russell 2000 usually is a pretty good sort of broader market measure of the health of the US stock market. And as I said there a few minutes ago, you can see all the stock indexes just jumped up there. So, a little bit of a surprise here that the markets are as bullish as they are. We've been watching the SMH, wondering whether this is theoretically SMH. This is the semiconductors ETF. SMH should be like the ultimate leading indicator in the stock market. And if there's going to be a top in the stock market, it usually comes in this thing first. And we've been talking a little bit about how divergences are potentially forming. Nothing is really actually confirmed yet. So the path of least resistance, higher highs and higher lows, defines a bull market, blah, blah, blah. But I just commented that if we actually did get a pullback following this Fed announcement and some of these divergences started to confirm, well, we better be damn careful here. Because you can see prices moved to new highs, but these momentum indicators did not. And the same sort of thing on Bitcoin. We've been talking a little bit, and really it shouldn't surprise. I mean, Bitcoin's basically the same thing as these risk proxies like big stock indexes. And what a big surprise, you can see the potential bearish divergence here in MACD. RSI, Willie Stupid. The sellers were ramping up there the other day. So as I said, and I basically messaged to the community this morning in our regular broadcast, if we see this MACD dip down below this lows, that will be a confirmed bearish momentum divergence. And if you don't know, we have a simple expression on this site that if you are a bull, and it's okay to be a bull, there's nothing wrong with being a bull, but if you are a bull and you see a confirmed bearish divergence, although I have no idea what all that stuff is, you better cool your jets. Just wait for the divergence to be cleaned out. Isn't that a shame? I can't even see our favorite picture. I know I have it in the library. I never remember where all the damn link is. Anyway, used to always show something along these lines. I don't know what this stuff is. Cool your jets. There you go. Anyway, we used to always put this picture out. If you see those bearish divergences confirmed, they haven't yet. We're getting close. And I suppose if we do actually start seeing some follow through to the downside here on this initial break here and price wanes, then that probably means we're in a bit of trouble. But it's not here yet. So right now, it's just really a question of, unfortunately, you can't really chase a market like this way up top here. And interestingly enough, if you're a crypto fan, ironically enough, there are crypto names that are basically in the same space and that look exactly the same as the semiconductors. So there is RNDR. This is sort of our in-house proxy on the AI build out. We have a couple others. There's also another one, Ocean. But you can see there is the potential div. It's not confirmed yet. And, if they keep pressing higher here, they might actually even start spitting out W's here. So anyway, jury's out. But the problem here is you see where the W's are. They're over here, not up here. So it's very, very dangerous to come in on the buy side here. And if you're long, rock on, keep spoon feeding the market. Sell halves on doubles, triples, quadruples, whatever. Get those risk-free trades. But new money purchases coming in right here, right now, that's a tough pill to swallow. So that's your backdrop of this market. Nice to see. It looks like crypto proxies still moving higher. Remember I said Ethereum is a great leading indicator in this space. So interesting to see Ethereum pressing up here. You can see all of the stocks are actually a bit paused, but actually it looks like the Dow here is trying to press to new highs. So, I heard Microsoft got a big upgrade today, so probably going to see some buying there. And interesting to see the gold market actually pressing to new highs. Interesting how the copper market is not, though. So, professor of economics isn't nearly as happy as some of these other proxies. So there's your backdrop. If anything, we probably want to keep an eye on the bond market. And, they got rid of the euro dollar contract, which was like my personal favorite proxy to follow short-term interest rates. They have this, sort of pegged proxy for interest rates, the SSPR or something or other. I can't remember exactly the name of it. Anyway, I had it on the screen here. In fact, maybe I can even show you that. Mind you, it was probably a whole bunch of backs ago. Do I have it? There it is. 3-month SOFR. I think that stands for I can't remember. Short-term offering rate or something like that. I can't remember what the SOFR stands for. But anyway, point of the matter here is they got rid of our beloved euro dollar. So we're going to use the 2-year T-note futures as our proxy for sort of the market's belief of short-term interest rates. And it looks like the market, you can see right across the board, the market is a lot happier now. We're going to listen to what Chair Powell has to say here. And it'll be interesting to get a read from the media that's present at his little speech here to see how in love or out of love they are. So everybody over on YouTube, we will all collectively count how many times you hear the reporter say, Chair Powell, Chair Powell. They want his baby. If they say, Mr. Governor, Mr. Chairman, Chairman Powell, you know that they're not really in love with him very much. It's remarkable. Somebody keep count. It's remarkable how you can use that as a proxy as to how much the sort of the Wall Street media is in love with Mr. Powell or not. So we'll have that running joke. If you are wondering why I always say, hey, he wants his baby, you'll understand what the heck I'm making reference to. Also, too, I suppose, the question ultimately here is, probably best to actually just pull up the chart. My question is, where the hell do I have it? What is the what should be the normal course of expectations here with regard to U.S. short-term interest rates? Should we be expecting the rates to be rising? Should we be expecting rates to actually be falling? And it's kind of interesting because I don't think a lot of people actually do this kind of analysis. But this is just a really simple sine wave, and most of the markets just move on a sine wave basis. And you can see this is raising interest rates with the sine wave pointing down, and this is falling interest rates with the sine wave pointing up. This was, of course, the great financial crisis, and so there was your big interest rate push up. It wasn't much. And there was your push down. And unfortunately, a lot of people in this generation kind of just got sort of used to this is the way interest rates are through that whole quantitative easing. And, the basically we got to do anything and everything we possibly can to ensure that the U.S. Economy and the U.S. banking system doesn't collapse. The U.S. banks had to go and buy back all those bad bonds. And that's what quantitative easing was, even though of course the public will be spoon-fed a completely different message. This is the period prior to the sickness, and Mr. Mr. Trump's presidency, that the US economy was starting to get back on the mend. The banksters didn't have to completely manipulate the curve to make sure that they weren't driven out of business. And of course, through this period, you remember Mr. Trump was like, why are you raising interest rates so much? Interest rates should be lower. But he was actually wrong. This period where interest rates were abnormally low was very abnormal. That was not normal for the market. This was our sickness stupidity. And of course, you can see the absolute panic in the marketplace. And interesting how panic over the great financial crisis, panic over the sickness, and frankly speaking, incredibly irresponsible monetary policy. And indeed, a lot of people that I respect in the marketplace, Stanley Druckenmiller for one, was absolutely aghast at what these stupid idiot bureaucrat bankster crooks did to us through here, because this was the start of our hyperinflation world and the way that they just printed money like a drunken whore. Drunken whores have printing presses for money, I guess. Anyway, so the Fed and Jerry, and interesting, this was one of the memes just posted in the lounge. I guess my credibility was the transitory thing after all. I mean, this guy, ironically enough, he's not even a banker by trade. I think all of these people were brought into office to basically expedite the Great Reset, and how basically this is a big con job to get us into the next growth cycle. And you poor millennials, the economy that you're inheriting is not going to be the same economy that I grew up in. And it's, of course, just disgusts a guy like me, because nobody in our society gives a shit about Generation X. It's like we jumped straight from the baby boomers, and as soon as the baby boomers were old enough and into retirement, and you look at all the politicians down in the States, they're still the baby boomers. What the hell are these people still doing in office? You see the way the leader of the Republican Party acts in the US Senate? I mean, the guy should be in a fucking geriatric home. What's going on here? And where is Generation X? We got completely, just passed right over. Anyway, blah, blah, blah. So, these idiot banksters, they're lawyers by trade. They don't even realize what the damage they did. They did realize that, holy shit, we've unleashed hyperinflation. And of course, we're all living in that world now. And so they absolutely cranked rates up here. Now, I might argue that, based on the sine wave, we're just about at the end of that raising cycle. Now we should actually be looking for a falling rate cycle. I have a feeling, though, it's going to look like this over the next year or so. And what a surprise. The announcement today, the Fed's going to do nothing. Why? Well, because we are heading into an election year. And the number one thing that the banking cartel does not want the public thinking is how utterly and completely they manipulate the entire economy. So the one way that they can do that is through the election year. They just back away, they go very quiet, and they literally say and do nothing, which sadly might actually even induce another one of these hyperinflationary waves. But we'll see. We'll cross that bridge when we come to it. I think that the people that are in power in the United States of America, hegemony, basically controlling the world economy outside of the fringe, like Vladdy and those kind of people. I think on balance, they are going to try and do everything in their power possible, maybe even encourage things like oil prices to crash, to paint the picture that inflation is dead. Because that's the one thing that will absolutely kill a current politician in power, is if we go to the polls and inflation is a major problem, they'll run that guy out of office in a heartbeat. So I think what's happening right now is you're going to have like the Fed try to back away and make it look like they're not manipulating the economy, which of course they completely are. Shadow government, all that crap. And number two, you're probably going to have, the Democrats who are sort of in bed with the banking industry, do everything in their power possible to both prop up the economy and try and mitigate the inflationary effects of all these policies that they've had recently. So there's your backdrop. Ironically enough, we should actually be expecting, and Powell himself, he should say today that the monetary policy, the way we've cranked it up here, this should be restrictive. And it's just a question of time until the effects of this restrictive policy actually play themselves out. We believe we have policy now at a restrictive level. We don't really need to restrict anymore. We are just going to let the data tell us what to do next, which of course is just bullshit for, we're not going to do anything right now. So there's your backdrop. Heading on back over to what we see happening here. Looks like we're getting follow through out of the currencies. US dollar index is still falling further here. Here is the daily chart of that US dollar index, but we'll be putting Chair Powell's video testimony right over this box. So if you want to follow what the dollar is going to do in the short term, that's this box up top here. And you can see we have our beloved Bitcoins and Ethereum just below. I've got the majors right beside this box. So we've got the euro, we've got the Swiss franc, we got the British pound. So there's your European currencies. Keep in mind the Swiss franc should move in lockstep with the gold price. We've got the Japanese yen. So this is going to be sort of our Asian economy proxy, big boy over in Asia. Euro is your big boy over there in Europe. Below Japan, we have the Australian commodity proxy, or let me say it, the Asian commodity proxy in the Australian dollar. And just below him, we have the North American commodity proxy through the Canadian dollar. We have all the bonds, 2 years, 5 years, 10 years, and then the long bond up on the screen here. And really, this is probably the market that's going to be most sensitive to what Mr. Powell has to tell us here in his speech. My hunch is he's going to basically say we are in wait and see mode right now. Remember, I showed you that chart of policy. I don't really foresee any more interest rate increases. And my hunch is that you're probably going to have the Fed go as quiet as possible over the next year as we go through this election process. So down below, as we said, we got the dollar. This will be Fed. In fact, actually, it looks like Chris already has that up there. You can see as soon as Powell starts coming to the podium and getting ready to speak, then we should start to see a little bit of back and forth here. And that's when sort of Brian will be quiet, and we'll try to be quiet at least. and we should get on with the show. I suppose the one thing that we could take away from the US dollar index is we did actually trade to new highs here recently. So I can't even call this an M top on the daily charts. If anything, what I would expect is let's get this done. Is this a bear AB equals CD? Could be. Of course, Brian would like to see 3 lower highs here. You can see we've got one high. Actually, well, that's not bad. Looks like this high is slightly higher. Jerry up there yet? Not yet, eh? So something along those lines. Yeah, see, that's actually a little bit suspicious to me. But the fact that they do have a railroad tracks up here leads me to believe that we do have this little top here. So zing, 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 zing. That is potentially a top. And we could I suppose, for lack of any direction right now, let's see how this looks following his speech. Well, we could start thinking about, has the market corrected at least 33%, but no more than 66, which it looks like that's the case, 33, no more than 66. And if that's the case, this is a trend continuation setup. And we're probably thinking something along the lines of bots. Oh, interesting. So we are right at the 25 level right now. I would actually prefer, I really don't like the look of this. I would prefer, if this is a short, let's get a rally back up top and then maybe a nice M like that to start working our way down. If this just pukes out right here, that's a lot of risk. So anyway, we'll keep an eye on that going forward. And really what I would say is if this thing does break down, actually interesting, we do have a pretty well-defined top. Is he speaking yet? Nope, nothing yet. Chris, maybe you can give me a holler if you see him come to the podium. But hopefully you can see we could do a Foggenbaum because that is a big M. So that'll give us some downside targets. Yeah, makes perfect sense. 2.618, doink, nailed it. Rally away from the lows. If we do puke out here, interesting. Next big objective would be 4669s, which would be somewhere between the AB equals CD objective and the alt ABCD at 127.2. Also, too, notice key horizontal support and resistance. This will be a big liquidity pool down in this area. Oh, and what a coincidence. That's right at that level. So if this thing does puke out, we go into some big risk on orgy, then probably you get your dump into there and something like that. So if this does happen, gee whiz, the stock market, probably your beloved Bitcoin, cryptocurrencies, the whole damn market's going to go absolutely apeshit orgy, risk on. We're all going to get rich. So pay attention for that, folks. I don't know whether it makes sense going and chasing that right there and hitting that. I think I would prefer to see a bit more structure up here to actually put that trade on. All right, so that's sort of your backdrop, what to expect. I would definitely say, though, at the end of this speech, we should see a different picture here. But having said that, as we're speaking right at present, it definitely looks to me like the knee-jerk reaction following this announcement was a big, fat risk on, risk on, risk on, risk on. Interesting how the crude oil market is just pausing here. Yeah, fascinating. There is talk that, and remember we talked about this earlier, is this going to be politically motivated? But there is also talk that the Saudis would actually like to drive the oil price down hard here to try and get the Americans out of the oil business again. So we'll see if that's actually influencing oil prices. But it is interesting how the very first thing that's come and emmed out here following the Fed announcement is this crude oil. So keep an eye out for that. Okay, so there's your backdrop. Yes. All right, so you want to throw up his little video right up here. And let's get ready for some fireworks. It's always fun to see how the hell this plays out. And Nick, I was just thinking about with you, I was talking to a lady who's planning on moving to Crete.
Without a significant
They're talking about how much you love Greek real estate right now, right?
But inflation is still too high. Ongoing progress in bringing it down is not assured. And the path forward is uncertain.
Are they still paying people to move to
As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal.
I even told her.
Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all.
China does yesterday's story. All right, so interesting.
Since early last year, the FOMC has significantly tightened the stance of monetary policy.
So Brian,
We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory. meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions. After picking up somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer-run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, The economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026, still above the median longer-term rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Chris Rugaber at
Look at
Associated Press.
Ethereum
I wanted to
leading us
ask,
higher.
how should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that you're pretty much done with rate hikes and the committee has shifted away from a tightening bias and toward a more neutral stance? Thank you.
So specifically on any, we do say that in determining the extent of any additional policy firming that may be appropriate, so any additional policy firming, that sentence. So we added the word any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle. Participants didn't write down additional hikes that we believe are likely, so that's what we wrote down. But participants also didn't want to take the possibility of further hikes off the table. So that's really what we were thinking.
Mr. Chairman, the microphone, sorry. Steve Leisman, CNBC. Happy holidays, Mr. Chairman. Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So, of course, I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is really how high to raise the policy rate. And that's really the question that we're still on here. We're very focused on that. As I mentioned, people generally think that we're at or near that and think it's not likely that we will hike, although they don't take that possibility off the table. So that's, when you get to that question and that's your answer, there's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question. And that's what people are thinking about and talking about. And I would just say this. We are seeing, strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature. And we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not. That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Can you give some color as to the nature of that discussion today? Thank you.
Sure. So it comes up in this way today. Everybody wrote down an SEP forecast, so many people mentioned what their rate forecast was, and there was no back and forth, no attempt to sort of reach agreement, like this is what I wrote down, this is what I think, that kind of thing, and a preliminary kind of a discussion like that. Not everybody did that, but many people did. And I would say there's a general expectation that this will be a topic for us looking ahead. That's really what happened in today's meeting. I can't do the head count for you in real time, but that's generally what happened today.
Go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. At this point, can you confidently say that the economy has avoided a recession and isn't heading for one now? And if the answer is no, I'm curious about what you'd still be looking for.
I think you can say that there's little basis for thinking that the economy is in a recession now. I would say that. I think there's always a probability that there will be a recession in the next year, and it's a meaningful probability no matter what the economy is doing. So it's always a real possibility. The question is it? So it's a possibility here. I have always felt, since the beginning, that there was a possibility, because of the unusual situation, that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing. This result is not guaranteed. It is far too early to declare victory. And there are certainly risks. It's certainly possible that the economy will behave in an unexpected way. It has done that repeatedly through in the post-pandemic period. Nonetheless, where we are is we see the things that I mentioned.
I'm curious if you're looking back on the past year, you talked about navigating by the stars under cloudy skies. Can you talk about some of the ways in which the economy surprised you most this year, where you thought it would behave in one way and had to pivot to respond? Thanks.
So I think forecasters generally, if you go back a year, were very broadly forecasting a recession for this year, for 2023. And not only did that not happen, that includes Fed forecasters and really essentially all forecasters. A very high proportion of forecasters were expecting very weak growth or a recession. Not only did that not happen, we actually had a very strong year. And that was a combination of strong demand, but also real gains on the supply side. So this was the year when labor force participation picked up, where immigration picked up, where the distortions to supply and demand from the pandemic, the shortages and the bottlenecks, really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus, or a little more than that, growth year, at a time when potential growth this year might even have been higher than that, just because of the healing on the supply side. So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the SEP from a year ago, there was a significant increase in unemployment. That didn't really happen. We're still at 3.7%. So we've seen strong growth, still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. it's a, that's what we see, and that, I think that combination was not anticipated broadly.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year, whether it's a coincidence, for example, that the spread between PCE inflation, core inflation, and the federal funds rate stays constant over the year. Are you simply calibrating against the fall in prices, in the price level that you're in the rate of inflation that you're expecting, as opposed to supporting the economy?
Nothing quite that mechanical is happening. The SEP really is a bottoms up, built from the bottom up, right? So I think people are looking at what's happening in the economy, and I think if you look at the big difference from September in the SEP, the expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth is turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest, again, significant progress toward greater balance across a broad range of indicators. You're seeing so many of the indicators coming back to normal, not all of them. But so I think that people look at that and they write down basically each individual writes down a forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so it isn't, you ask about real rates, I take it, that is something that we're very conscious of and aware of and monitor, and it's certainly a big part of, it's a part of how we think about things, but really it's broader financial conditions that matter, and as you well know, it's so hard to know exactly, what the real rate is or exactly how tight policy is at any given time. So you couldn't follow that like it was a rule and think that you would get the right answer all the time, but it's certainly something that we're focused on. And indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over that, if I could follow up, has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out, given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election. Do you want to front load this, in other words?
Yeah, no, we don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things, we just can't do that. We have to think, what's the right thing? We'll do the things that we think are right for the economy at the time when we think is the right time. That's what we'll always do. So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over, that assessment really over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case anymore, obviously, as it was 60, 90 days ago. So that's how we're approaching things. And as I mentioned, we wrote down this SEP, and it talks about people have individual assessments of when it will be appropriate to start to dial back on the tight policy we have in place. And that's a discussion we'll be having going forward, but that's another assessment that we're going to make very carefully. So as time goes forward.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've argued over the last year that policy tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf. The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level, with cuts beginning around March. Is this something that you are broadly comfortable with?
So this last year has been remarkable for the sort of seesaw thing, back and forth we've had over the course of the year, of markets moving away and moving back and that kind of thing. So, and what I would just say is that we focus on what we have to do and how we need to use our tools to achieve our goals, and that's what we really focus on. And people are going to have different forecasts about the economy, and those are going to show up in market conditions, or they won't, but in any case, we have to do what we think is right. And, in the long run, it's important that financial conditions become aligned or are aligned with what we're trying to accomplish.
Yeah, this
In
is
the
totally
long run, they will
one-directional
be,
market, eh?
Of course, because we will do what it takes to get to our goals. And ultimately, that will mean that financial conditions will come along. But in the meantime, there can be back and forth, and I'm just focused on what's the right thing for us to do, and my colleagues are focused on that too.
The markets seem to think inflation is coming down credibly. Do you believe we're at the point where inflation is coming down credibly?
Listen, I welcome the progress. I think it's really good to see the progress that we're making. I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say I'm not calling into question the progress. It's great. We just need to see more. We need to see continued further progress toward getting back to 2%. That's what we need to see. So it's our job to restore price stability, and that it's one of our two jobs along with maximum employment, and they're equal. So we're very focused on doing that. As I mentioned, we're moving carefully at this point. We're pleased with the progress, but we see the need for further progress. And I think it's fair to say there is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
Gina.
Gina Smilik, New York Times. Thanks for taking our questions. In the SEP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way, is below trend growth necessary to cut rates, or would continued progress on inflation alone be sufficient?
So we'll look at the totality of the data. Growth is one thing. So is inflation, so is labor market data. So we'd look at the total, if we make decisions about policy changes going forward, we're going to look at all those things, and particularly about as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we'd be looking for. If we have stronger growth, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%. We will get it down to 2%. But if we see stronger growth, we will set policy according to what we actually see, and so that's how I would answer.
I guess the question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you have growth that's robust, what that will mean is probably will keep the labor market very strong. It probably will place some upward pressure on inflation. That could mean that it takes longer to get to 2% inflation. That could mean we need to keep rates higher for longer. It could even mean ultimately that we would need to hike again. It just is. It's the way our policy works.
Go to Neil.
Hi, Chair Powell. Neil Irwin with Axios. How do you interpret the state of the labor market right now? And in particular, you've referred even today to evidence that it's coming into better balance. What would you need to see to conclude that it has reached that balance?
So on the better balance side, just a lot of things. It's you see job growth still strong, but moving back down to more sustainable levels given population growth and labor force participation. The things that are not quite, but let me go on with that list. Claims are low. If you look at surveys of businesses, they're sort of the era of this frantic labor shortage are behind us, and they're seeing a shortage of labor as being significantly alleviated. If you look at shortages of workers, whereas they thought job availability was the highest it had ever been or close to it, that's now down to more normal levels by so many measures: participation, unemployment, so many measures, the unemployment, job openings, quits, all of those things. So wages are still running a bit above what would be consistent with 2% inflation over a long period of time. They've been gradually cooling off, but if wages are running around 4%, that's still a bit above, I would say. And I guess there are just a couple of other, the unemployment rate is very, very low. And these are, but I would just say overall, the development of the labor market has been very positive. It's been a good time for workers to find jobs and get solid wage increases.
Claire?
Claire Jones, Financial Times. I'd say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that we are going to have a soft landing. Yeah, when we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
It may be. A common theme is that while inflation is coming
That's a good
down,
question.
that's very good news, the price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like. And what will happen with that is wages are now, real wages are now positive, so that wages are now moving up more than inflation as inflation comes down. And so that might help improve the mood of people. But we see those public opinion surveys.
That was
we
just,
can do
fuck you,
is
prices are never
to
coming
do
down
our
because we've
jobs, which
inflated
is
the
to
economy to deal with
use
the
our
debt
tools to
problem.
foster price stability, which has such great benefits over such long periods of time, and which is the thing that really enables us to work for and achieve an extended period of high employment, which is so beneficial for, families and companies around the country.
Victoria?
Hi, Victoria Guido with Politico. I wanted to ask,
Prices will never
on the
come
flip
back
side
down.
of if things start to deteriorate rapidly, if we do fall into a recession, if we do start to see unemployment rise at sort of the levels of inflation that we're seeing now, how would you all think about that in terms of rate cuts? Would that be a sign that you've done your job demand-wise?
Sorry, if
If the economy looks like it's starting to fall into recession, if the jobless rate starts to rise?
that's not something we're hoping to see. Obviously, we're hoping to see something very different, which is continuation of what we have seen, which is the labor market coming into better balance without a significant increase in unemployment, inflation coming down without a significant increase in unemployment, and growth moderating without a significant increase in unemployment. That's what we're trying very much to achieve, and not something we're looking to see.
But would you take that as a signal that you should cut rates?
Obviously, what we'll do is we'll look at the totality of the data, as I've mentioned a couple of times, and certainly the labor data would be important in that. And if you can describe a situation like that where if there were the beginning of a recession or something like that, then yes, that would certainly weigh heavily in that decision.
Michael McKee from Bloomberg Television and Radio. Mr. Chairman, you were, by your own admission, behind the curve in starting to raise rates to fight inflation. And you said earlier, again, the full
Mr.
effects of our
Chairman.
tightening cycle have not yet been felt. How will you decide when to cut rates, and how will you ensure you're not behind the curve there?
So we're aware of the risk that we would hang on too long. We know that that's a risk, and we're very focused on not making that mistake. And we do regard the two, we've come back into a better balance between the risk of overdoing it and the risk of underdoing it. Not only that, we were able to focus hard on the price stability mandate, and we're getting back to the point where, which is what you do when you're very far from one of the two mandates. You're getting now back to the point where both mandates are important, and they're more in balance too. So I think we'll be very much keeping that in mind as we make policy going forward. And the things we'll be looking at, I've already described. We're obviously looking hard at what's happening with demand. And what we see the same thing other people see, which is a strong economy, which really put up quite a performance in 2023. We see good evidence and good reason to believe that growth will come in lower next year. And you see what the forecasts are. I think the median growth, median participant wrote down 1.4% growth, but we'll have to see. It's very hard to predict. We'll also be looking to see progress on inflation and the labor market remaining strong, but ideally without seeing the kind of large increase in unemployment that happens sometimes.
When you begin the cutting cycle, will it be essentially run the same way you do it now with raising rates, where you basically do trial and error cut and see what happens, or will you tie it to some particular measure of progress?
We haven't typically tried to articulate, with one exception, really specific target levels, which was, some of you will remember the thresholds that we used in, I guess, 2013. The answer is, these are things that we haven't, really worked out yet. We're sort of just at the beginning of that discussion.
Thank you, Mr. Chairman. Edward Lawrence of Fox Business. So if the Fed cuts rates, as the dot plot is showing, about 75 basis points, does that signal or that there's a belief of weakness next year in the economy?
It wouldn't, if that were, first of all, let me just say, that isn't a plan. That's just accumulating what people wrote down. So that's not something, this, but allow me to say it again. We don't debate or discuss what the right, whose SEP is right. We just say what they are and we tabulate them and publish them. So it's important for people to know that. But it wouldn't need to be a sign of, it could just be a sign that the economy is normalizing and it doesn't need the tight policy. It depends on, the economy can evolve in many different ways, right? So, but it could be more what I just described.
And you focused on core inflation. We've heard from in other meetings. How sticky is core inflation right now?
Well, that's what we're finding out, and we've seen real progress in core inflation. It has been sticky, and famously, the service sector is thought to be stickier. But we've actually seen reasonable progress in non-housing services, which was the area where you would expect to see less progress. We are seeing some progress there, though. In fact, all three of the categories of core are now contributing. Goods, housing services, non-housing services, they're all contributing at different levels, meeting by meeting, or rather report by report. So, yeah.
Okay, let's go to Katerina.
Katerina Saraiva, Bloomberg News. Thanks for taking our questions. I just wanted to ask a little bit about, we had some pretty positive data this morning and yesterday. I'm assuming those were not incorporated into the forecasts we see today. But I just wanted to ask, how that kind of adds to your thinking, on the inflation outlook. Right.
So we got CPI the morning of the first day, and we got PPI the next day, which informs the translation into PCE. So it's very, very late in the game, but nonetheless, participants are allowed to, encouraged to update their SEP forecasts until probably mid-morning today. After that, so staff has to accumulate all of that and create the documents that you see. So until about mid-morning, maybe late morning, it's okay to update. And I believe some people did update their forecasts based on what we saw today.
How are you, when you think about, starting to think about the rate cuts next year or whenever they come, how do you think about the economy we're in now, kind of post-pandemic? Do you think that there's been significant structural shifts, and is that going to change how you look at a rate cut path?
The question of whether there have been fundamental structural shifts is really hard to know the answer, and a very interesting one right now. The one that would affect, one that comes to mind, though, is just the question of where the neutral rate of interest is. And so, for example, if it's risen, and I'm not saying that it has, but if it were to have risen, that would mean that interest rates would need to be a little bit higher to convey the same level of restriction. The thing is, we're not really going to know that. People will be writing papers about that 10 years from now and still fighting about it. So it's just that it's going to be uncertain. So we're going to be making policy in this, difficult, uncertain, really unprecedented environment. Someone once said that you know the natural rate of interest by its works, and that's really right. But that's very difficult because policy operates with a lag. So it's one of the reasons why we slowed down this year. We started slowing down at this meeting last year, reducing the pace at which we were adding restriction. And over the course of this year, we really slowed down a lot to give those lags time to work. In terms of demand, has demand shifted more away from services into goods? You can make a case for that the shift back into services has not been complete, and it doesn't look like it's ongoing, but I don't know if that's right. Maybe people just bought so much stuff that they temporarily don't want any more stuff. They haven't got any place to put it.
Let's go to Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said back in July that you needed to start cutting rates before getting to 2% inflation. As you mentioned, PCE inflation is now running at 3.5% on core. On a 6-month annual basis, core PCE is running at 2.5%. Though when you look at super core and shelter, they are, of course, stickier. So in looking at the different components of the data, how much closer do you have to get to 2% before you consider cutting rates?
I mean, the reason you wouldn't wait to get to 2% to cut rates is that policy would be too late. I mean, you'd want to be reducing restriction on the economy well before 2%, because before you get to 2%, so you don't overshoot. If we think of restrictive policy as weighing on economic activity, it takes a while for policy to get into the economy, affect economic activity, and affect inflation. So I can't give you a precise answer, but if you look at what's in the SEP, and I think you'll see a reasonable estimate of the time lags and things like that it would take.
Do you think below 3% would be reasonable?
I wouldn't want to identify any one precise point, because I would be able to look back then and probably find out that it turned out not to be right. But we'll be looking at it and looking at the broad collection of factors.
Hi, Chair Powell, Jean Young with Market News. Wanted to go back to the stickiness of inflation question. Over the past couple of years, a lot of central bankers have talked about the more difficult last mile of getting inflation back down to 2%. Yet it's also been surprising how fast inflation has come down this year. I'm curious, do you think something has changed in our understanding of inflation? Or do you subscribe to this notion still, or is it something different about the U.S. economy? Thank you.
I think this, we felt since the beginning that it would be a combination of two factors. The first factor is just the unwinding of what happened in the pandemic, the distortions to supply and demand. And the second thing would be our policy, which was weighing on aggregate demand and actually making it easier for the supply side to recover because of lower demand. We thought those two things were going to be necessary. Sorry, say the last part of your question again.
If there was something different about the U.S. economy.
Yeah, so it's not that, it may or may not be about the U.S. economy being different. I think that this inflation was not the classic demand overload, pot boiling over kind of inflation that we think about. It was a combination of very strong demand, without question, and unusual supply side restrictions, both on the goods side but also on the labor side, because we had a participation shock. So this is just very unusual. And, we had the view, my colleagues and I broadly had the view, that we could get a lot of, you had essentially a vertical supply curve, because you ran into the limits of capacity at very low levels because there weren't workers and because people couldn't, the supply chains were all broken. So we had the view that you could come straight down that vertical supply curve to the extent demand reduced. And, something like that has happened. It happened so far. The question is, once that part of it runs out, and we think it has a ways to run, we definitely think that the the sort of supply chain and shortages side has some ways to run. Does labor force participation have much more to run? It might. Immigration could help, but it may be that at some point you will run out of supply side help, and then it gets down to demand and it gets harder. That's very possible. But to say with certainty that the last mile is going to be different, I'd be reluctant to suggest that we have any certainty around that. We just don't know. I mean, inflation keeps coming down, the labor market keeps getting back into balance, and it's so far so good. Although we kind of assume that it will get harder from here, but so far it hasn't.
Okay, we'll go to Megan for the last question.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I want to ask about the balance sheet, given the Fed's focus now on proceeding carefully and considering rate cuts. And can you talk us through what the latest thinking is, and has there been any consideration of altering the pace of quantitative tightening at all?
We're not talking about altering the pace of QT right now, just to get that out of the way. So balance sheet seems to be working pretty much as expected. What we've been seeing is, that we're allowing runoff each month. That's adding up. I think we're close to 1.2 trillion now. That's showing up. The reverse repo facility has been coming down quickly, and reserves have been either moving up or, as a result, or holding steady. At a certain point, there won't be any more to come out of, or there'll be a level where the reverse repo facility levels out, and at that point, reserves will start to come down. We still have, that we intend to reduce our securities holders until we judge that the quantity of reserve balances has reached a level somewhat above that consistent with ample reserves. And we also intend to slow and then stop the decline in size of the balance sheet when reserve balances are somewhat above the level judged to be consistent with ample reserves. We're not at those levels. With reserves close to $3.5 trillion.
Notice he's reading
we don't
word
think
for
we're at
word
those reserves. There isn't
exactly
a lot
what
of
he's
evidence of
supposed
that.
to
We're
say.
watching it carefully, and so far it's working pretty much as expected, we think.
Adjusting that thinking at all by the time you're considering or moving forward with rate cuts? Is that time to rethink, or are you still going to follow that thinking?
So I think they're on independent tracks. So you're asking, though, the question, I guess you're implying the question of can you continue with QT at such time, QT, which is a tightening action, at such time as policy is still tight? And the answer is it depends on the reason. If you're cutting rates because you're going back to normal, that's one thing. If you're cutting them because the economy is really weak, so you can imagine you have to know what the reason is to know whether it would be appropriate to do those two things at the same time.
Thank you.
Thanks very much.
All right, I guess that's it, folks. What are some general messages we heard out of Mr. Powell there? I think probably one of the biggest messages we heard was there ain't no way you are going to see the prices that you saw a few years ago in our society again. And frankly speaking, this is exactly part of Klaus's Great Reset. You just got to get used to it, right? If anything, what we probably have to do here to really understand that part of the equation is we need to see M2 money supply. What's interesting about the money supply is the way the housing market here is not even the slightest bit interested in backing off. Also interesting too, I've said this repeatedly to all of you guys that yes, I got too many things on my head right now. Let's see if I can find, did I just call it M2? Yeah, this is the most recent study that I've been sort of focusing on is, we all would ideally like to get back to this world, but you can see, here is this world, and here is where we are right now. And I think you could actually argue that basically prices are twice, right? So that's 100 and some odd percent there. This is now 190. So basically everything in our economy since when Donald Trump was president of the United States, everything's basically just doubled in price. And I get the impression that he is very happy at the fact that we're now sort of going sideways. So the rate of change is not dramatic, and you're not going to see that 10% increase annual rate, right? That's what this shit is here. You're just not going to see that, and they're perfectly happy if prices just sit here. And you even heard him specifically say that, when that, and I thought the best question that was asked through that whole thing was from the British reporter who said that, well, sentiment, like if you turn on any social media, like all these YouTubers talking about like, Chris, what's your girlfriend's name? Oh, sorry. I always do that. And I don't think he likes
Danielle
it.
D. Martino Booth.
There
That's
you
what you're
go.
referring to.
You listen to her, and she was technically, hey, I was a Fed person, right? Well, you listen to her, and you think that this guy was about to fall. But you listen to Jerry there, and I don't hear any of the similar messages from Jerry. What I heard from Jerry there was don't expect prices to come down. And the way that the public is going to have to deal with these increased prices is they have to demand higher wages. And he even said there, we are starting to see wages tick up to offset those price increases. And frankly speaking, that's exactly what's supposed to happen. You're supposed to have cost push. So that's all this bullshit, right? The costs of everything in our society all just doubled through that bullshit. And now we're going to have demand pull, where the workers say, hey, we can't afford these higher rents. We can't afford these higher food prices. We can't afford these higher this, higher that, whatever. And Jerry's like, well, you're just going to have to get used to it. And the only way that you're going to be able to deal with it is you got to demand higher wages down the road. So my hunch is that this is all the function of the Great Reset. And now, of course, the debt to GDP numbers, I mean, they're still awful, but they're not nearly as bad as they were here. Why? Because they basically artificially doubled the size of GDP by doubling the money supply. So, I mean, that was the big message that I sort of gleaned out of what I heard from him. Keep in mind that asset prices in the marketplace, quite often they have a disconnect with sort of Joe Sixpack. So I did see that through that whole conversation, the stock market just kept motoring higher. And interestingly enough, I was watching Ethereum out of the corner of my eyes. Ethereum just kept motoring higher here. As well as, and I thought this was pretty important because remember we had mentioned this prior to the actual video getting started, is that they just blew right through the bot short entry level here. So I hate to say it, but I think that this bot is now active. And this kind of looks like a head and shoulders top right there. So, I mean, do you have three lower highs to work with? This is sloppy at best. If anything, I do see a little bit of a gap right on the price chart here. So I wouldn't be surprised if there is some sort of counter trend rally back up to fill in that gap. But I think what this comes on is not so much anything that happens in the United States. I think this is actually more a function of, I mean, do we want to go and look at that China to trade? Well, actually, China. Well, I mean, we'll see what happens with Canada. The interesting thing about Canada, of course, is that technically it's supposed to be sort of the United States' little cousin. So if the economy is really booming down in the States, I don't think Canada is going to suffer too hard. But, we had put on, everybody, of course, was absolutely in love with this China story and how China was going to become the next, world leaders and all that kind of stuff. What was the name of the chart that I had there? I called it like the China trade or something like that. Just give me a second here. But there it is, China. That's why. But I still think that if there's going to be a problem in the world, it's going to be out of China. Here is a typical China large cap ETF. This is a weekly price chart. I mean, maybe this is the bottom, who knows? But you can see structurally, just like I was talking about with the US dollar index and bearish bots and all that kind of fun stuff. I mean, this thing's still forging the new lows here. So not really in a huge hurry to call a bottom there. And unfortunately, you come over to TRI on Tuesday. We have our CTO who's out of the Netherlands come on, and he talks a little bit about the European economy, and he's pretty not very happy about what's going on over there in Netherlands, and to a certain degree, what's going on in Europe in general. I guess I had on here the anticipation that maybe this would be a bullish bot, but you can see we've gone through 66%. So your bullish bot thesis, that's gone. Bearish bots still seem to be working away. It looks like we did hit that bot objective, so maybe that's a bottom. But if things really get out of control there over in China, 1.618 would just basically be a test of these lows. As long as we keep painting lower highs and lower lows, I still think, and I've said this repeatedly, that this isn't a conversation about the United States economy. This is more a conversation about the world economy and how it's going to do. In the face of these very strong U.S. data, strong U.S. economy, i.e., U.S. is the hegemony, so that means that they get to set interest rate policy. Anybody who's borrowing in U.S. dollars, if you're getting your funding out of the U.S. market, you've got to pay those higher interest rates, and a lot of these international people are getting absolutely killed. And also too, how does this South American situation play out? That's, a big uncertainty right now. I saw the headline heading into this event here today. Somewhere we read that Argentinian peso, and I was asking if somebody could find the trading symbol for it, fell like 54%. I mean, do we see another absolute collapse in South and Central American economies? Very possible. So there's your backdrop. Still think the U.S. economy is uber strong. And now actually we do have bearish chart patterns on these higher time frame charts on the U.S. dollar working. The short-term message, interestingly enough, it was just one directional through that whole press conference, which I did find fascinating. Suppose now we have to watch for if these are very short-term price charts. You can see on the 4-hour chart, US dollar is finally lifting off of that. And keep in mind, that is a really, really ugly 4-hour candle. Popular guy on, I suppose you can see it here. When you get these huge, ugly 4-hour candles, this does some major technical damage. This is probably what we should expect right now over the next few hours is some back and forth here. And then if we get like M structure tops coming in further, then this will probably be like an AB equals CD lower. So serious technical damage done through that event. And I don't know. I mean, I suppose what I heard out of, interestingly enough, did anybody keep count? How many times did we hear, "Oh, Chair Powell, you're so handsome. You're so virile. I want to have your baby." Anybody hear anything about that? I think I heard one.
That I heard anything about that specifically, but I did see the ES break out to new highs, contract highs specifically on the March contracts. I thought that was interesting.
Oh, there we go. Well, show me a new high and I'll show you something, right? Let's head on over to our higher time frame matrix. This is now the half-hour charts. And here is Chris talking about the stock market. They all just were booming higher through that speech. Quite remarkable, eh? And these will be the spot contracts, but I suppose we could probably go and look at something like a March futures contract. And the old expression, right? Show me a new high and I'll show you a buy. So this is the lower time frame, just 1 minute. I suppose we probably can get off of that for now. But the question ultimately here is Chris is saying that he does not want to have Jerry's baby. All right, I think I got that message. But at the same time too, there is the old high there on the stock market. These are the futures contracts. Of course, they anticipate, especially this far out. Like, keep in mind, when this was making new highs here, that was July through the summer. So this was a much deferred contract. But point of the matter here is, in the old adage in the market, show me a new high and I'll show you a buy. So we can always just put that, we'll sync that. All right, that should be in there. And then let's go look at that daily chart and see what it looks like. Boom. All right, so there is your breakout to new high. It'd be interesting to see whether the market can accept above here, right? If we see this closing print above here, and I think that in itself is actually a very, very bullish signal of the stock market. Although I got all these lines on here. Sorry for being so messy. Interesting comment there, Chris. I might even say that, like I said, I only heard one person say Chair Powell. Did see a lot of Mr. Chairman, and I even saw a number of reporters not even mention his name. So that's an interesting sort of sentiment vote. And I think that British reporter, she actually nailed it on the head, that the public is thinking very, very differently than the central banksters. The public thinks that we're recession, we're going to tip over, but even the stock market as the ultimate leading indicator, there ain't no signs of recession here anywhere in sight. And we might even want to look over at the NASDAQ as sort of the ultimate sort of, leading indicator of the leading indicators. Remember, we were talking about SMH earlier today. SMH, it's come off a bit from its high. So let's keep an eye on how that acts. Remember, we never did have that bullish breakout on the momentum. So that's interesting. But let's head on back on over and see what the NASDAQ is doing here. NASDAQ, where's our NASDAQ? There it is. Oh yeah, we're definitely into Marches here now. So let's see what we got on the daily chart out of the NASDAQ. Have we broken out to new highs? Well, you tell me. What kind of chart pattern is that? In fact, we even talked about this recently. I probably even talked about it. I don't know, maybe it was in the after party. But let's see, daily. Yep. So this is definitely, I don't even know where the old high is on this chart. That's got to be it, eh? From the summer. So what kind of pattern is that? You should all look at that and go, oh my goodness. That's a pretty bullish chart pattern, folks. So, and the interesting thing is, does it make sense that something like the NASDAQ and something like Ethereum as Mr. Vitalik's supercomputer of the world in the next new millennium, all that kind of talk? RNDR, good old Sjord's proxy in the semiconductor space and, graphics cards and all that. Which should be the fact that it is pushed to new highs here. No signs of breaking down there yet. I get the distinct impression tech stocks are probably pretty happy here. So there, and actually, yeah, look at that. You can see the NASDAQ is just booming here. So actually, that does have me scratching my head a little bit here. That's the one thing coming out of this that actually surprises me a bit. And you know what we might want to do here is, that is a daily chart. So a bit surprising that semiconductors are not trying to break out top here. Let's see what our QQQs look like, right? Because this will be a proxy on the NASDAQ 100 itself. And interesting, same story. So be careful here, folks. If anything, you know what this kind of looks like? This looks like through this period here. So you can see when the divergence actually confirms, that's not necessarily a sell signal. You might actually even have another push to new highs. You know, we look for trade location, then we look down for indicator confirmation. At this point, the market's gone into divergence. Then at that point, you want the M, and there's the M there. And that took, following the divergence coming in, divergence came in there in June 21st. And the actual M, the trade signal, came in at the very end of July, beginning of August. So you might have the divergence actually confirm here, and then it takes another month or two for the market to actually top out. That wouldn't surprise me at all. I am hearing a lot of people started talking about how they're expecting something big and ugly to happen in sort of February, March. I might argue, we saw that in a cup and handle pattern on the stock indexes, because we have broken out to new highs here on this. Now we got this Pyth. I don't know what the hell this is. I'm probably looking at the wrong quote here. Let's get a better quote here for you. QQQs. Actually, I think it's a fund, isn't it? There it is. That's what we should be looking at. Sorry about that, folks. All right. Hey, you can see a little double top here. It was busted out as of there. So I can take that off the screen. Was that the short trade? Yeah, looks like it, eh? But what I was showing you there just a second ago is if we go there up to there, that is a consolidation range. And, this isn't the best example, but remember we saw in those futures, little cup and handle pattern. That's sort of what that looks like there. So where the heck is this going to take us? Hello. 461. We're now at 402. You can very easily see this stock market add another 15%. And then you ask, well, where the hell's that going to come from? I think I heard somebody came out with a huge upgrade of Microsoft. And you can see we were thinking about doing bull call spreads here. This would probably be an example of one of our bull call spreads that's actually going to hit the maximum profit window. But I did hear one analyst here today, I think it was today, or maybe it was over the past couple of days, calling for like a $600 price target on Microsoft. How long would that take to happen? So there's $600 there. If we just follow this simple trend line growth, then that puts us up somewhere there. October. Is there anything political that might be happening in the United States of America around the end of October, beginning of November of 2024, that if the market was nice and uppy and everybody was happy, then maybe it might just be the guy's doing an okay job. My 401k plan's kicking ass. So I'm going to let him go back into office and do another 4 years. I wonder. So that's kind of actually, that's not a terrible way to look at this, folks. Anyway, there's your market. If you enjoyed the broadcast, I hope you got some value out of it. Not nearly as commentary today as before. But maybe hit the like button, subscribe to the channel, and you'll be notified. Hit that bell off of the YouTube thing, and you'll be notified when we do more broadcasts. Finish off the broadcast today, probably a really good anecdote of the power of 2.618. So you can see, and I showed you a few times why I like using this chaos theory kind of thinking. And if we, I suppose, drill down to maybe like a daily chart, I think we showed that. I think what happened here off of this level is basically we hit 2.618 and some chaos entered the market. Is this actually a buy now? I think I'm from Missouri. So we potentially had an inside bar fire there. I suppose it is technically this little doji bar yesterday, and this is daily chart, and we did recapture the 13 EMA. So I suppose on balance, that's a good thing as well too. This was a new high. So if we do simple things like connect the dots, could we see Bitcoin work its way up against this trend line? Sure. It wouldn't be shocking. I would say though that if we do see things like 78.6 fibs, don't be shocked if you actually see some people come in and start to take short shots against these highs, because that's just what traders do. I think I was showing you earlier. Yeah, notice candle body highs. There's that doji, which was the original high. That's the inside bar fractal sell signal. Notice that's right off that 78.6. So as long as I see this trend continue, don't see any M's. Look at the Russell 2000 small cap market. Still surging to new highs here. As long as I don't see any M's coming in over here, I don't see anything that's going to stop this market. We have a bit of a pullback, but certainly no M's yet. And if anything, probably a good idea. Keep an eye on things like Ethereum. I've said Ethereum, I think, is an excellent sort of proxy in your crypto space for sort of risk on bets. That's within a hop, skip, and a jump of breaking out to new highs as well. So I think the general message, and I've said this repeatedly, is I don't think it's a good idea to get too heavy on the buy side up here. You were, of course, supposed to, in fact, actually Ethereum, I think it bottomed like last fall. I mean, like literally, like not this year, last year. Yeah. So there is the bottom in Ethereum. New little bottom came in here. We're pushing up. Looks like we pushed up against a trend line. Interesting. That's right off of that peak. So this actually should be a really interesting level. And actually, I kind of like this. This makes a lot of sense to me. What I want to see here, I mean, first and foremost, we have a rule at TRI that we don't really want to take a trade at a trend line, and definitely don't buy heading into a trend line like this. What we really want to see, believe it or not, is break above that trend line and then give me some sort of market structure signal on the other side of that trend line. So I don't think I'm going to be getting like outright buy signals on something like Ethereum for quite a while. This is going to take probably some consolidation. And I would imagine a lot of these altcoins, it's the same sort of thing. Then if we're really lucky and we get some violent price breaks, and this is basically my attitude on crypto now for probably the next few years, pullbacks are buying opportunities. So interestingly enough, I could very easily, you see there is a trend line. I could very easily see that we actually reject off of this line. We have to come back down against these lows and swim against things like reload zones. Does that happen after the halvening? It might. I mean, keep in mind, halvening event is basically right about there. So could this maybe come up, punch up through here, and then we do something like that, and then we have to correct? Very possibly. So there's no way in heck I'm going to be able to get like a buy signal on a lot of these assets that's moved up here. You should be long from the bottoms, and you should be spoon feeding into these rallies. If we do get the pullbacks into reload zones, then great. I'll be more than happy to go and buy some more. And there are some crypto names that are down in the bottom end of their ranges, and I'm just going and nibbling away on assets that they're just handing away, giving away. But that's the type of investor that I am. I like to buy stuff when it's really cheap. I don't like to buy stuff when it gets expensive like this. Okay, there's your summary for the day. Of course, we'll have fun playing at TRI. Tomorrow is Thursday, so you actually get a big dose of Julian. He should have a refreshing view of what he's seeing in price action. And I hope you enjoyed this. Like I said, if you got some value out of this, I only see 17 likes, even though we did have about 70 or 80 people watching. So I don't know, maybe give me some feedback. Put in the comments, well, Brian, I would give you a like if you didn't talk so damn much. I don't know. Anyway, have yourselves a great day. PMA for the win. Slow and steady wins the race. Don't take no win nickels. Remember what your number one job is. All that. And the only left Brian say is, goodbye for now.